Datavault AI Inc. closed its latest regular trading session on Friday, July 10, 2026 at 4 p.m. Eastern Time at an exact price of $0.3603 per share, marking an intraday drop of 4.58% on a trading volume that climbed past 8.15 million shares. While most market spectators looking at standard online investing feeds see a struggling sub-dollar penny stock facing severe downward volatility, the underlying transactional reality reveals an asset-backed tokenization platform that just finalized a formal three-party joint venture agreement to back a new stablecoin tied to the United States dollar, tying its immediate operational prospects directly to global sovereign asset distribution. Retail investors tracking mainstream software like the Robinhood app or using standard investing sites often assume that microcap technology equities trading at these levels are structurally broken businesses with bleeding balance sheets. The expectation is that Datavault AI Inc. is merely another speculative shell capitalizing on artificial intelligence buzzwords, yet the reality points to a company that reported a massive 443% year-over-year revenue growth in its first quarter financial update for 2026, while concurrently securing hundreds of millions of dollars in institutional commitments and global intellectual property protections. This stark contrast between public market valuation and private balance sheet expansion creates a fascinating tension for anyone participating in self-investing or managing an individual brokerage account. Scrutinizing this disconnect requires moving past the surface-level price action seen on a standard digital trading terminal and looking at the actual mechanics of how this business captures institutional capital. When individuals look for investment help regarding microcap firms, the standard playbook warns against entities that have recently rebranded or shifted their target markets. Datavault AI Inc. was previously known as WISA Technologies Inc. before changing its name and identity in early 2025 to align with its data monetization and digital twins framework. For someone using platforms like Fidelity Investments or Interactive Brokers Trading, tracking a historical trailing metric of this magnitude can be difficult because the historical trailing metrics often carry the weight of the old business model. The general market expectation was that the legacy audio technology would hold the company back, but the operational reality shows that they have split their operations into distinct acoustic science and data science divisions, allowing them to leverage their high-definition wireless sound infrastructure while expanding heavily into real-world asset tokenization. The immediate volatility we are observing in the daily swings, where the stock routinely experiences double-digit % movements on heavy retail volume, highlights a classic battle between institutional accumulation and retail liquidation. While a typical investor using a basic individual brokerage setup might panic at a 4.58% drop in a single Friday session, larger participants are examining the structural financing term sheets that have been signed throughout the first half of 2026, including a $2 billion structured financing agreement announced at the start of June. To understand why this massive trading volume is pouring into a microcap stock, one must look at the specific catalysts that dropped during the first weeks of July 2026. On July 10th, the company formalized its joint venture with Unity Reserve Holdings to launch Mandela Digital and the associated Mandela Dollar stablecoin, securing an exclusive global technology mandate that guarantees recurring technology fees tied directly to the issuance, redemption, and compliance verification of that digital asset. Just 2 days prior to this announcement, the United States Patent and Trademark Office issued a notice of allowance for a patent specifically targeting naked and excessive short selling through tokenized dividend distribution systems. This is an incredibly specific and aggressive piece of intellectual property that could fundamentally change how public companies protect themselves against predatory short sellers, giving Datavault AI Inc. a powerful licensing tool that traditional tech firms do not possess. If you are analyzing this through the lens of institutional positioning on the Interactive Brokers platform or tracking flow on the Fidelity trading platform, you can see that these structural announcements are creating a baseline of asset value that the current equity price completely ignores. Retail traders on the Robinhood stock trading application might see the price trending near its 52-week low of $0.25 and assume a bankruptcy risk, missing the fact that the company strengthened its working capital to approximately $140 million through a successful registered direct offering of common stock earlier this year. Comment below how many shares of Datavault AI Inc. you currently hold, or if you think microcap tokenization platforms are too risky for an individual brokerage account. The tension between expectation and reality deepens when we examine the actual numbers supporting their full-year guidance. Management has consistently reiterated a $200 million revenue target for the full year of 2026, which represents an approximate 400% year-over-year revenue growth compared to the fiscal year 2025, where they achieved their first-ever profitable quarter in the final months of the year. For a company valued at a market capitalization fluctuating between $100 million and $300 million, depending on the daily equity swings, a forward revenue target of $200 million, coupled with an expected gross profit margin of 78%, signals unit economics that are drastically superior to many mid-cap software enterprises. When retail participants allocate capital through online investment choices or follow automated asset allocations like those found in Schwab Intelligent Portfolios, they rarely see companies with this specific risk-to-reward ratio because algorithmic filters often screen out companies trading under $1. This creates an informational asymmetry where active self-investing participants using advanced tools like SoFi Active Investing or specialized Interactive Brokers account setups can exploit the mispricing before institutional mandates allow larger funds to buy in. The massive institutional funding agreements, including a $120 million non-dilutive funding package secured for the nationwide rollout of their infrastructure platform, indicate that private credit markets are viewing this business with far more confidence than the public equity markets currently reflect. Let us look closely at the architecture of what this enterprise actually does to generate cash flow. The Data Science Division leverages its proprietary systems known as Data Value, Data Score, and the Information Data Exchange to allow corporate clients to visualize, value, and securely commercialize their internal data assets. Instead of selling data outright, which creates massive regulatory and privacy hurdles, they use machine learning automation to create digital twins and tokenized intellectual property wrappers, letting organizations monetize their metadata assets with strict compliance tracking. Concurrently, their legacy Acoustic Sciences group continues to generate revenue through high-definition wireless sound transmission systems under the WISA E brand, partnering with international consumer electronics brands to deploy premium home theater systems. This two-pronged business model means that while the market treats them purely as a speculative blockchain play, they possess an underlying hardware and software licensing revenue stream that cushions their operational expenses. An investor tracking tech trends via ordinary investing sites might view the tokenization market as a highly speculative sector driven by meme coins, and indeed, Datavault AI Inc. even saw its tokenized asset experiments list on international exchanges recently, but the core corporate focus remains locked on institutional asset management and enterprise infrastructure. When you compare this trajectory to the performance of major large-cap technology equities, the contrast becomes even more evident. While NVIDIA stock attracts trillions of dollars of capital due to its dominant chip manufacturing position, and Apple stock or Tesla stock dominate daily retail options trading volumes across every Fidelity brokerage or Robinhood crypto account, these massive entities are trading at premium valuation multiples that leave little room for massive operational multiples of growth. An intelligent portfolio built around long-term wealth preservation often holds these tech giants through traditional vehicles like Fidelity ETFs or Fidelity mutual funds, but high-growth components require looking at smaller technology vendors that provide the software layer for next-generation asset classes. The microcap landscape is filled with failed ventures, which is why a typical individual brokerage account holder prefers the safety of managed options like SoFi robo-advisor systems. However, when a company transitions from losing $6 million a quarter to generating record revenue growth and posting positive net income within a 12-month window, the fundamental thesis demands a complete reevaluation. The reality of their financial turnaround is outstripping the market narrative that treats them as a volatile penny stock, creating a compressed valuation coiled for a response if their second half 2026 exchange launches deliver the anticipated